Hi, and welcome again to the CDFM study group. My name is Helen Thomas. Today I'm going to be doing a brief wrap-up of the CDFM Module 3. I'm going to be asking random questions. I'll pause a little bit, and then I'll give you the correct response or answers. I will not be going over the actual page numbers because at this point, you should be able to get the answers or go through the study guides and find the answers for yourself. So I'm going to start off real simple with the knowledge check questions in Module 3. So question 1 says, federal appropriations law can be categorized into which 3 topical areas? That is correct. Purpose, time, and amount, the PTA. Second one, in the Department of Defense, final decisions of fiscal law questions are officially rendered by whom? It's rendered by the DoD General Counsel, which is like your lawyers, or your courts, which makes sense. What are the basic types of budget authority? So remember, there are 6 budget authority. So what are the basic types? Appropriation, borrowing authority, contract authority, loan and loan guarantee, monetary credits, offsetting collections. Let me make sure that was 6. Hold on. All right, operation and maintenance, O&M, is an example of what type of appropriation? It's an expense type and it's an annual appropriation. So those can be the 2 categories if you, depending on whatever choice or selections you have in the answers. What about RD&T, research development, technology, and equipment? That is an example of what type of appropriation. It's a multi-year appropriation. Budget authority does not expire in what type of appropriation? The no year. Number 8, Article 1, Section 9 of the U.S. Constitution. So remember, the Article 1 already should tell you that it governs Congress or the legislative branch. So Article 1, Section 9 of the U.S. Constitution gives the power to appropriate funds for operating the government in which branch? So automatically, because of the Article 1, you know it's the legislative branch or Congress, because it was Article 1, Article 2, Article 3, legislative, executive, and judicial branch. All right, so constitutional authority, let's go fiscal law. When we talk about Article 1, Section 7, Article 1, Section 8, and Section 9, what is the purpose of those laws? Section 7 gives Congress the authority to raise revenue. Section 8, collect taxes. And Section 9, which is the one we should be most familiar with, Article 1, Section 9, that is the law that says no money shall be drawn out of the Treasury unless we have an appropriation law. So that's why we need an appropriation. For most people, they say we need a budget by 1 October. But for us on the financial management side, the proper wording is the appropriation law is what grants us the budget authority that gives us the money to spend in the federal government. So what GAO authoritative source document covers the appropriations? That is the GAO Red Book. Remember in previous one, we've learned the GAO Red Book deals with appropriation. The GAO Yellow Book deals with auditing. And the GAO Green Book deals with internal control. Those are the only 3 that's covered in this entire study guide. So just remember those 3 and which one covers what topic. So we talked about purpose, time, and amount. For every appropriation, it comes with a specific purpose, time, and amount, which 31 U.S. Code that tells you it's the Anti-Deficiency Act law governs purpose, time, and amount. That is 1301, 1502, 1341, 1342, and 1517. I'm going to repeat that again. 1301, 1502, 1341, 1342, and 1517 in that order. There's one for purpose, 1301, one for time, 1502, and there's three for the amount appropriation. And all you got to do is make sure for the amount, you know, the 1341 says you can't spend any more than what was appropriated. And the 1517 says you can't spend any more than what was apportioned. That also tells you, because when we talked about the flow of funds, I mentioned that the flow of funds starts with Congress appropriates the money, passes it down, OMB apportions down to DOD, and DOD issues allotments to the field. So for instance, 1341, 31 U.S. Code 1341 says we cannot spend any more than what was appropriated. Well, if you remember the flow of funds, then the section that gets the appropriated funds is Office of Management and Budget, OMB. So that law applies to OMB. That's how you're able to put that thing together. The same way with 31 U.S. Code 1517 that says I can't spend before or in excess of apportionment. Well, apportionment goes to the Department of Defense, State, Navy, all of those guys, state departments, education. They get apportionment, so they cannot spend any more than what was apportioned. So by knowing that knowledge, you know some additional things that goes with that topic. All right, how do we pay for commanders' coins? When it comes to fiscal law, what is the rule behind commanders' coins? In a general rule, that is considered to be a personal expense. I'm sure there's some exceptions to the rule, but for our purposes, coins are not to be purchased with appropriated funds. When it comes to purpose, what are some questions you have to ask to determine if you have the right appropriation to purchase your requirement? Well, you have the three-part necessary expense doctrine. One, does what you want to buy, does that requirement bear a logical relationship to the funding that you're trying to use? Two, is what you're trying to buy otherwise prohibited by some law? So Congress says you can't make that purchase. So whether you have the money or not, if Congress states you can't buy it, then you can't. So that's part of understanding the purpose. And then the third rule for the necessary expense, do I make that purchase if that item can be bought some other way than using appropriated funds? So that's a three-part test. When it comes to time, what are some things we need to look at? The bona fide need rule. Current year needs uses current year funds. That's the general rule. Yes, there are exceptions if we need long lead time to buy the item today because the manufacturer will not be able to produce the item for another 2 months into the new fiscal year. That's different. In general terms, bona fide need rule goes with the time frame, meaning my current needs must be for current requirements using current funds. All right, so we talked about severable and non-severable services. A severable service means that if I start that, let's say a contract, and the government no longer needs that service, I can end the contract, but I still would have received a benefit up to that point when I cancel the contract. That's a severable contract. A non-severable means I can't stop it. Once I enter into that contract, that job needs to be completed for me to get a benefit. For instance, if I have to repave a parking lot, if the contract has been awarded, we've started a job, well, if I end that contract in the middle of I don't want to pay that money anymore, well, I'm not going to get the full benefit. So the idea behind obligation is that once you've entered or you make that obligation, you pay the full amount of whatever that contract is, regardless of crossing fiscal year. Severable contract, if it's greater than 12 months, I will pay the 12 months with current appropriation, but I will need new appropriation to pay the additional, whether it's 13 months, 14 months. So I'll pay 12, and then the other month I'll have to wait until I get the new appropriation to fund that portion of that contract. All right, looking at the life cycle of appropriation, we talked about O&M and MILPERS being 1 year or annual appropriation. They are expense type appropriation. You have research, development, test, and evaluation. That's RDT&E, which is a 2-year appropriation. Procurement is a 3-year appropriation, investment type. Shipbuilding and conversion, Navy, your SCN appropriation is a 5-year appropriation, and it's also an investment. So those that are 3 or more are investment types. And your military construction is a 5-year appropriation, meaning those funds are good for 5 years once you receive them. So your no-year appropriation are those appropriations that once you receive them, they do not expire. Of course, Congress still has restrictions on your use of those appropriations. So your no-year, the most common no-year appropriation is your working capital fund. And the perfect example of a working capital fund is, think of your commissaries. The commissary takes their funding, they buy the food items, place them on the shelf. The customer comes in, buys the food item, and then that money is then used to replenish items on the shelf. So it's a revolving account. So the words no year appropriation, does not expire, working capital funds. The aim is not to make a profit. All of those goes with no year appropriation. There are only 2 ways in which a no-year appropriation is closed. One, if the president or the head of the agency deems that the purpose have already been served, then that no-year appropriation will be canceled. Or if there are no disbursement, no action within the last 2 years, 2 consecutive years, then that no-year appropriation will be canceled. All right, let's talk about the life cycle of an appropriation. So I just went through O&M, MILPERS, RDT&E, test and evaluation, procurement, SCN, and MILCON. Understand that an appropriation goes through 3 phases. Phase 1, they are current or open. Phase 2, they are closed. And let's try that again. Phase 2, they are expired. And phase 3, they are closed. So in phase 1, the timeline that I went over, whether it's 1 year, 2 year, 3 or 5, current mean I can make new contracts, new obligations. When they enter the expired state, they stay expired for 5 years. For example, if I have a military construction appropriation, the life cycle for that is 5 years. So that construction funds is good, is current, is open for 5 years. After that 5th year is done, it is then expired for a second 5 years. So we're talking 10 years. And on that 11th year, that appropriation is closed. So what you need to know about this is what happens in each phase. So I said phase 1, when it's current, when it's open, I can make new obligations. Phase 2, when it's expired, I can only make adjustments to contracts that's already in the system. No new obligations when the account is expired. And when it's closed, I lose all accountability of those funds. If it enters the closed state, those funds are returned to the Treasury, miscellaneous account in the Treasury. However, when the account is closed, there's a 1% rule that says I can use up to 1% of current appropriation to pay for a bill that comes in a closed account. All right, so let's recap the flow of funds. Flow of funds says Congress appropriates money, appropriations. What happens once Congress appropriates the money? Two things happen. One, the Treasury issues the Treasury warrant or appropriation warrant. That's the notification to the agencies that the account's been set up. Notice been received from Congress and the account's been set up. Remember, Article 1, Section 9 of the Constitution said the Treasury has to have an appropriation law for it to disperse funds. So once the appropriation law is in effect, then the Treasury issues the Treasury warrant. The second thing that happens after Congress appropriates the money is Office of Management and Budget, OMB, which is the resource manager for the president or the executive branch. OMB begins the apportionment process. And we've talked about that. Agencies allot, once they get their apportionment, DOD issues allotments to Army, Navy, and so forth. And we commit administrative reservation of funds, obligate legal reservation of funds, outlay. Outlay is a disbursement when the funds, the money is removed from the Treasury to pay a bill. That term is called outlay. What are the four major functions of finance? The four major functions are entitlement, EPCC. Entitlements, payments, collections, control of funds. Is the soldier entitled? We got to make sure they get the right payment. If they owe money, we want to make sure we get collections. Once we get funding from Congress and are higher, we need to properly control our funds. Which Department of Defense agency is responsible for the finance and accounting of all DOD entities? That is DFAS. Which DOD regulation governs the finance and accounting? DOD FMR, Financial Management Regulation 7000.14R. That's correct. How long do we keep civilian pay records? 56 years. And how long do we keep regular personnel records? 6 years and 3 months. 6 years and 3 months. All right. What are the 5 ways to disperse government funds? There are several ways to disperse government funds. Electronic funds transfer, treasury check, large disbursements, dispersing payment systems, and miscellaneous pay. Which law requires the government to receive a claim that is made within 6 years from when the claim was accrued? That's the Borrowing Act, 31 U.S. Code 3702. The borrowing, BARRING. All right, what are the 3 types of accounting? Budgetary, financial or proprietary, and Managerial cost accounting. Bam! What are the three federal financial statements? Balance sheet, statement of net cost, statement of change in net position. What law requires agencies to have auditable financial statements? The Chief Financial Officers Act of 1990. It was the Government Management Reform Act of 1994, which amended the CFO Act to require audited financial statements from the 24 CFO agencies and an audited financial report of the United States government. So remember, initially it was 1990. It designated 24 CFO agencies that had to be audited, and so further guidance was done in 1994 with the Government Management Reform Act of 1994. Who is the Chief Financial Officer of the Department of Defense? The Undersecretary of Defense for Comptroller. So make sure you read the question. Are they asking you which DoD agency or who is the principal advisor to the Secretary of Defense on financial matters, budgetary resources? USD Comptroller. So make sure you're reading the question. The agency is the Department of Defense, and the section or the CFO principal advisor is the Undersecretary of Defense Comptroller, USD Comptroller. Different types of government funds. You have appropriated funds, which is what most of us deal with. Reimbursable funds we deal with. Revolving, we talked about that no year appropriation is the same thing as revolving. Trust funds and NAF, non-appropriated funds, which your MWRs deal with more so than we do. All right, so what's the difference between? So on a reimbursable, which is a MIPR, Military Interdepartmental Purchase Request, you can either be a project order or an Economy Act order. The difference is if it states on the contract that it's a project order, it means that that order can cross fiscal years and you do not deobligate the funds at the end of the fiscal year. The opposite is the Economy Act order means at the end of that fiscal year, I have to deobligate. So it cannot cross fiscal years. So usually so think of PE, project order and Economy Act order, since PE goes together. So a MIPR is either a P or an E, project order, Economy Act order. Project is a project. Think about a project means once I pay that money, I'm going to leave that funds regardless of the fiscal year. Economy, because I'm thinking of the Economy Act order says it's usually a one-year appropriation, annual appropriation, and it means at the end of that fiscal year, I cannot cross. So I have to deobligate any funds that have not been already obligated. And then outlay is the term. So instead of disbursement, you want to learn the term and say the term outlay. Outlay occurs when the funds are removed from the treasury to pay that contractor or that vendor. All right, it's extremely important that you know the accounting codes or account codes for the Standard General Ledger. So account codes range from 1,000 all the way to 8,000. And the best way to remember as you're learning the formulas associated with the balance sheet, creating the balance sheet and the statement of net cost. And also we talked about the three types of accounting was budgetary. So a budgetary transaction begins with 4s. So you can set that aside. All your 4,000 numbers is considered a budgetary account. Your balance sheet is made up with the formula assets equal liability plus net position. So your 1,000 numbers are assets equal your 2,000, which is liability, plus net position, which is your 3,000. So you've just learned your 1,000 equaled your 2,000 plus your 3,000. Your budgetary is always 4,000. Any number that starts with a 4 is a budgetary transaction. Your 5,000, 6,000. To calculate the statement of net cost, the formula is expenses minus revenue. So that's my 6,000 minus my 5,000. That's my expenses minus my revenue equals statement of net cost. 7,000 is gains and losses, and 8,000 is memorandum. Make sure you know the normal balance. So the normal balance, your assets and your expenses have a normal debit balance with a D. Your budgetary and your gains and losses may have either or both. So everything else has a normal credit balance. When it comes to the flow of funds, we talked about from Congress appropriates the money, OMB apportions, DOD gets allotments down to us, we commit, obligate, we buy things, we pay the bill. Required transactions when it comes to accounting, the first transaction, when Congress appropriates the money, it requires a budgetary and a proprietary transaction. In between, all those other transactions requires a budgetary entry only. Transaction number 6, when we receive the items and when we pay the bill, so 6 and 7, we have both a proprietary and a budgetary transaction. All right, what's the definition of managerial cost accounting? Think of a manager, right? So the process of accumulating, measuring, analyzing, interpreting, and reporting costs. So think of as management level, that's the level of detail that a manager wants to understand costs. Not just what the end result is, but what are all the defining underlying costs associated with the bare number. Two formulas, ratio analysis that is used with managerial cost accounting. Ratio analysis is current ratio or quick ratio. The difference is current ratio, you look at all your cash plus your accounts receivable, how much money you're supposed to get back, plus inventory divided by what you owe, your current liabilities. So the current ratio is a measure of the entity's ability to meet its current obligations. So measure of your liquidity. How fast can you meet your current obligation? The quick ratio, meaning that, or acid test, you do not account for your inventory. The test of an entity's immediate solvency. So we need to end this organization, this business right now. Quick ratio gives me a good percentage or rate in what my solvency is. All right, so auditing, remember fund balance with the Treasury is simply, okay, what's my balance at the Treasury? So don't let this stuff confuse you any more than it needs to be. The auditing standards, so for GAO, Government Accountability Standards, when we talked about appropriation, we say we can find the most authoritative source on appropriation is the GAO Red Book. Now, on the auditing side, the most authoritative source from the GAO, Government Accountability Office on auditing, is the Yellow Book, GAO Yellow Book. So the 4 basic standards are auditor independence. You're not supposed to be a part of that organization. No influence. Professional judgment. It's not about, hey, I got you. It's about, okay, let's do this properly so I can help you to get better. Auditor competence. Your auditors got to be trained. They have to be qualified. They have to have a certain amount of training each year. Quality control and assurance. Not only do they have to have that training, but they also have to have an external audit every 3 years. So make sure you review those. audit, we have performance audit versus financial audit. So make sure you know the differences there. The Comptroller General, whenever you hear the term CG or Comptroller General, the Comptroller General is the individual in charge of the GAO. So it's like saying GAO. All right, so I'm just going to go recap some of the highlights from individuals who've recently taken the test. They said to make sure you know what an invitational travel order is, and those are usually TDY orders that can be generated for, let's say, a VIP, to pay the travel of a VIP individual to come to be a guest speaker in your organization. We talked about the purchase of coins, the government purchase card, the GPC, where you buy supplies, is for mission essential supplies. So not things that you would need a contract for. Those are like your pens, your papers, and so forth. Ensure that you're able to calculate the net pay problems that's in the finance section. Know the purpose of the DSSN number, dispersing station number, to identify the office that's dispersing the funds. What is included in the statement of net cost? If you know the formula, statement of net cost is expenses minus revenue. 6,000 code minus the 5,000. So how you'll see that is you'll get a series of transactions starting with numbers from 1 to 8, for 1,000 numbers and 8,000 numbers, and you have to decide, okay, is that an asset? Is that a liability? Is that a revenue expense? And then they might say, calculate the balance sheet. Balance sheet is assets equal liability plus net position. And you'll be able to pull those three numbers out, equal the two self-balancing account, or both the statement of net cost and the balance sheet. Because anytime you have a formula that says one side equals the other side, those are self-balancing account. When it comes to basic allowance for housing, BAH, I have a note here. It says that reserve personnel will typically are entitled to BAH differential. So while they're on active duty, they don't get full BAH, they get BAH diff or partial BAH. Make sure you know the 6 budget authority, the contracting authority, appropriation, and so forth, so that if a different one is added to the list, you will know which one is not a part of. So make sure when you're reading your question that they're not asking you which one is not a budget authority, which one is not the functions of finance. So you have to know what right looks like to know when you have the wrong response. So which is not included in a premium pay? When it comes to civilian pay, TDY pay is not considered premium. Premium is like overtime pay and all of those additional things that's added on. Who is responsible for correcting audit findings and recommendation? Well, the organization that was evaluated. The necessary expense doctrine contract question about using O&M funds to fund a 10-year contract. Can you use O&M? Why or why not? Remember, O&M is an annual appropriation, 1 year. So I can't fund a 10-year contract with a 1-year appropriation. So that should be your response. You kind of have to think of, okay, well, I'm using O&M funds. The appropriation life cycle for RDT&E, research, development, testing, and evaluation. That was a 2-year appropriation. Review under, I think it's under the finance section of the civilian. Make sure you review family, friendly leave act and what the timeline. I think you get, what, 12 hours a year or something like that. So make sure you review that. Permanent duty travel, OCONUS. If you're PCSing permanent chain of travel from overseas to stateside, your your losing organization pays your travel. If you're going stateside to stateside, your gaining organization pays for your travel. All right, this concludes the wrap up for CDFM Module 3. Good luck, and I look forward to seeing you next time.